Your WRINtv on-demand video will begin shortly. Meanwhile, be sure to register for WRINtv alerts by clicking on the link below.
As we head into PCI this year, there are a lot of large issues that face the industry. There are a number of headwinds that make it tough to be a reinsurer right now. We've got structural changes, we've got cyclical changes, and we've got changes that we have to adapt to within the macro environment. We've got very low interest rates that make it very, very difficult to earn anything on your investment income. With new money rates below 1%, it's very, very challenging to earn adequate returns on your investment portfolio. We also have a very weak economy, which gives rise to low demand, low exposure growth. On the structural side, we've got changes to the way our clients are buying. There's more and more consolidation in the industry, so higher retentions. There's more bundling of purchases and more pressure being exerted to lower margins. From a cyclical standpoint, we've had rate decreases for a number of years. We're starting to see that change, but we still have some way to go before we make up for the rate decreases that we've seen over the last number of years. So there are factors that are affecting both demand and price. In the case of demand is held low by the fact that we have a weak economy and because of the structural changes that are occurring in the way our clients are purchasing, higher retentions and more bundling. On the other hand, price is starting to react. So whereas you normally have a clear relationship between demand and supply, here what you have is you've got demand off, but you actually have price that is increasing as a result of another factor, and that is the lack of investment income. Capital markets and non-traditional products are having a significant impact on the traditional market. We have new capital vehicles that allow capital to enter the market very efficiently. That has a dampening impact on the traditional cycle, on the ability to generate excess returns after a loss event. And that will have an impact on pricing in the industry, material impact going forward. Another consequence of these new capital vehicles is that they are changing the way reinsurers have to think about themselves. We have historically thought about ourselves as putting our own capital at risk. But now what we have to do is recognize that there are vehicles for third-party capital and that they are looking for intellectual or experience to manage that capital on their behalf. And more you're finding reinsurers are actually in the business of being asset managers, managing their own assets, but also managing assets on behalf of third parties. Looking forward, the imperative for reinsurers is to understand the structural and cyclical changes and make sure that we're adapting to them. On the one hand, I'd say one significant challenge is making sure that we continue to have access to risk. There are risk classes which are being less and less seeded, and in order to put together an optimal portfolio, we may well have to find other ways to access those risks. So the imperative is to access risk, to build an optimal portfolio of those risks, and to be indifferent to the form of capital, whether that's your own capital or whether that's third-party capital which is attracted to that risk class. So at PartnerRe, in response to these industry changes, you can be assured that we'll be working hard to adapt to the cyclical and the structural changes that we see. That'll mean making sure that we've got access to business, making sure that we're building an optimal portfolio, and responding appropriately to the new capital vehicles that we're seeing as a permanent source of capital in the industry. You can also expect that we'll be looking to broaden our client base, that we'll be looking to bring the same level of professionalism, financial security, and stability to our trading partners.